Hello, friends. Today, we're diving into one of the most fascinating insights from the groundbreaking book, Thinking Fast and Slow by Daniel Kahneman, a masterpiece that reveals how our minds make decisions and why we often fall into mental traps without even realizing it. In this video, we'll explore a powerful concept from the book that can transform the way you think, especially when it comes to trading, investing, and everyday decisions. Understanding these psychological patterns can help you avoid costly mistakes and make smarter, more rational choices. So stick around as we break down this eye-opening topic in a simple and practical way. And hey, if you find these insights helpful, don't forget to like, share, and subscribe to stay updated with more lessons that sharpen your mindset and boost your decision-making skills. Let's get started. Prospect theory. It's one of the most powerful insights from Thinking Fast and Slow by Daniel Kahneman, and it reveals a surprising truth about how we make decisions under risk. When it comes to trading, this theory explains why losses feel so much more painful than the joy we get from equivalent gains, and understanding this can be a game changer for your trading mindset. Here's the core idea. People don't treat gains and losses equally. Kahneman's research shows that the pain of losing is psychologically twice as intense as the pleasure of winning. So, if you gain $100, it feels good, but losing $100 feels much worse. This imbalance affects how traders evaluate risks and rewards, often leading to emotional and irrational decisions. Think about it. When a trade is in profit, many traders rush to lock in gains out of fear the market might reverse. Even if the setup is still strong, the emotional relief of securing a win takes over. But when a trade is in loss, the opposite happens. Instead of cutting the loss early, traders hold on, hoping the market will turn around, because accepting the loss feels too painful. This is why many traders let losses grow while cutting profits short, a dangerous habit that goes directly against successful trading strategies. Kahneman explains that this behavior is rooted in how we frame outcomes. When a situation is presented as a potential gain, people tend to become risk-averse. They play it safe. But when a situation is framed as a potential loss, they become risk-seeking, willing to take bigger risks to avoid feeling that pain. Here's a simple example. Imagine you're given two choices. 1, a guaranteed $500 profit. 2, a 50% chance to win $1,000 or nothing. Most people choose the guaranteed $500, even though the second option has a higher potential reward. But if you flip the scenario and offer a $500 loss versus a 50% chance to lose $1,000 or nothing, most people take the riskier option because they're desperate to avoid locking in a loss. This bias leads to irrational decision-making in trading. It explains why traders hesitate to exit losing positions, hoping for a recovery, even when the logical choice is to cut losses. It also explains why traders frequently take profits too early, afraid the gains might disappear. So, how do you overcome the grip of prospect theory in your trading? The key is to shift from emotional decision-making to a rational, rules-based approach. Instead of reacting to the emotional weight of losses and gains, focus on the probabilities and expected outcomes. Here are 2 practical steps. 1, set clear exit rules. Define your stop-loss and profit targets before you enter a trade and stick to them. This prevents emotional bias from taking control. 2, think in probabilities. Don't get caught up in individual wins or losses. Evaluate your strategy over a series of trades. What matters is the long-term edge, not any single outcome. By recognizing how prospect theory influences your behavior, you can break free from these emotional traps and make clearer, more rational trading decisions. System 1 versus System 2 thinking. This concept from Thinking Fast and Slow by Daniel Kahneman reveals how your brain operates in 2 distinct modes. And when it comes to trading, understanding these 2 systems can mean the difference between impulsive mistakes and rational decisions. Let's break it down. Kahneman describes your mind as having 2 systems constantly at work. System 1, fast, automatic, and intuitive. It's always active, making snap judgments without conscious effort. System 2, slow, deliberate, and analytical. It steps in when complex problems require deeper thought and logical reasoning. Now, here's where it gets interesting. Most of your decisions are made by System 1, and that includes decisions while trading. This system is built for speed, relying on mental shortcuts called heuristics to process information quickly. It's the system that reacts when you instinctively hit the brakes while driving or recognize patterns in a chart without even thinking. But speed comes with a cost. System 1 is prone to biases and errors. It oversimplifies, jumps to conclusions, and struggles with probabilities. And in the fast-paced world of trading, these mental shortcuts can be dangerous. For example, when you see a stock rapidly rising, System 1 might trigger a fear of missing out, pushing you to enter impulsively without proper analysis. Or, when a trade goes against you, System 1 activates loss aversion, making you hold on to losing positions longer than you should. On the other hand, System 2 is your rational thinker. It's methodical, logical, and better at handling complex calculations. This is the system you engage when you analyze a company's financials, backtest a strategy, or carefully plan an entry and exit point. But here's the catch. System 2 is lazy. It requires effort to engage and often defers to System 1 to save energy. In fast-moving markets where decisions need to be made quickly, System 1 usually takes control, leading to emotional knee-jerk reactions. Kahneman's research shows that most trading mistakes happen because traders rely too heavily on System 1 and fail to engage System 2 when it matters most. Let's bring this to life with a common scenario. Imagine you see a stock breaking out to a new high. System 1 screams, "This is a sure thing. Buy now before it goes higher." Without thinking, you enter the trade. But what happens next? The breakout fades, the stock reverses, and you're left holding a losing position. System 1 reacted impulsively without considering the broader context, like volume confirmation or resistance levels. If System 2 had been in charge, it would have slowed you down, analyzing the breakout carefully, checking key indicators, and asking, is this a genuine breakout or a trap? So, how can you balance these two systems and make smarter trading decisions? Number 1, create a trading checklist. Engage System 2 by setting clear, rational rules for every trade. Before placing an order, ask yourself, is this trade part of my strategy? What's my risk to reward ratio? Where will I exit if I'm wrong? This forces you to slow down and make decisions based on logic, not emotions. 2, use time to your advantage. When possible, pause before making trading decisions. If you feel the urge to act immediately, that's System 1 pushing you. Taking a moment to review the data allows System 2 to step in and evaluate more rationally. 3, journal your trades. After each trade, analyze what influenced your decision. Was it a snap judgment from System 1 or a reasoned decision from System 2? Over time, this practice helps you identify emotional triggers and improve your discipline. The key takeaway? System 1 will always be part of your trading. It's fast, intuitive, and automatic. But if you want to make consistent, profitable decisions, you need to train System 2 to take the lead, especially in moments when the market is testing your patience and emotions. The planning fallacy reveals why traders consistently underestimate the time, risks, and challenges involved in trading. It's the reason many traders enter the market expecting quick, easy profits, only to face harsh reality. At its core, the planning fallacy means people are overly optimistic about how long a task will take and underestimate the difficulties they'll encounter along the way. Kahneman discovered that when people plan, they tend to focus on the best-case scenario while ignoring the potential obstacles and setbacks. And in the world of trading, this bias can be dangerous. Many beginners believe they'll become profitable in a few months, imagining fast progress, consistent wins, and financial freedom. But here's the truth. Trading is harder and takes longer than most people expect. This unrealistic optimism leads to risky decisions like over-leveraging, chasing quick gains, or skipping proper education. Kahneman points out that the planning fallacy isn't just about time, it also blinds you to the real risks involved. Traders often underestimate how much they could lose on a bad trade or how long it might take to recover from a losing streak. This is why so many blow up their accounts. They plan for success, but fail to prepare for failure. Let's break it down with a real-world scenario. Imagine a trader who starts with $5,000, believing they'll double their account in 6 months. They've watched a few tutorials, practiced on a demo account, and feel confident. But what happens when the market turns against them? A few losses in a row, and suddenly their confidence is shattered. The emotional toll of losing money and the time required to rebuild skills weren't part of their original plan. Why does this happen? Because System 1, the fast and intuitive part of your brain, loves a simple, positive story. It tells you, if others are making money, why can't you? But System 2, the slower and more analytical part, should be asking, what are the real risks and how long will it take to master this skill? So, how do you avoid falling into the planning fallacy as a trader? Hashtag 1. Base your expectations on reality, not optimism. Kahneman emphasizes the importance of using reference points. Instead of guessing how fast you'll succeed, study real traders who have become consistently profitable. Most successful traders take years, not months, to master their craft. Hack 2. Plan for the worst-case scenario. When you build a trading plan, don't just think about how much you could win. Ask yourself, how much am I willing to lose? What happens if I have a 10-trade losing streak? Can I stick to my plan when things go wrong? This mindset helps you prepare for the reality of drawdowns, emotional struggles, and the time commitment needed to succeed. 3. Set realistic milestones. Instead of focusing on quick profits, aim for small, measurable goals like improving your win rate, managing risk, or staying emotionally disciplined. Progress comes in phases, not overnight. For example, instead of saying, I'll make $10,000 this year, shift to, I'll follow my trading rules for 90 days without breaking discipline. This approach engages System 2, encouraging logical, sustainable growth. 4. Review and adjust regularly. Most traders fall into the planning fallacy because they don't revisit their assumptions. Regularly review your performance, identify what's working, and adjust your strategy accordingly. Kahneman's research teaches us a crucial lesson. Optimism feels good, but realism keeps you in the game. By acknowledging that trading takes time, involves risk, and demands mental resilience, you can avoid the planning fallacy and develop a mindset that supports long-term success. Hindsight bias reveals how traders convince themselves they knew it all along after a market event happens. This false sense of certainty doesn't just distort memory, it feeds overconfidence, leading to poor future decisions. Here's how it works. After a trade plays out, whether it's a market crash, a stock rally, or a reversal, you might think, I saw that coming. But did you really? Hindsight bias makes you rewrite history in your mind. You forget the uncertainty you felt before and believe the outcome was predictable. Why does this happen? It's how your brain seeks comfort. Markets are unpredictable and uncertainty is uncomfortable. So, when the outcome becomes clear, your brain rewires the past to make you feel like you had it figured out all along. This illusion of knowing feeds your ego, and that's where the danger lies. In trading, this bias fuels overconfidence. If you believe you accurately predicted past events, you start trusting your gut feelings more than your data. You take bigger risks because you think you have a special insight, when, in reality, you're just falling for a mental trick. Let's break it down with an example. Imagine a trader who watches a volatile stock. They think it might go up or it might crash. They're unsure. Then the stock plunges. Afterward, they tell themselves, I knew it was going to crash. That belief feels satisfying. But here's the problem. They didn't act on that knowledge. The uncertainty before the event is erased, and this false confidence could lead them to make riskier trades next time. And the more this happens, the worse it gets. Each time you believe you knew it, your confidence grows, while your ability to assess real uncertainty weakens. Eventually, you start ignoring risks, skipping analysis, and trusting intuition over evidence. Kahneman explains that hindsight bias blinds you to how random and complex markets really are. It tricks you into believing the future will be as clear as the past seems, and that illusion can be financially devastating. So, how do you protect yourself from hindsight bias and stay grounded in reality? 1. Record your predictions. Before every trade, Write down why you're entering the trade, what you expect to happen, the risks you foresee. After the trade, compare your original notes with what actually happened. This keeps you honest and reveals how much uncertainty was present. You'll see that outcomes are rarely as predictable as they feel afterward. 2. Acknowledge uncertainty. Accept that the market is full of unknowns, even for the best traders. Instead of trying to be right, focus on managing risk and probabilities. No one can predict the future perfectly, and understanding that keeps you humble and cautious. 3. Separate luck from skill. Just because a trade worked doesn't mean you were right. It might have been luck. Evaluate your trades based on process, not outcome. Did you follow your plan? Did you manage risk? If the answer is yes, that's a successful trade, no matter the result. 4. Be wary of I knew it thoughts. Whenever you catch yourself thinking, I knew it all along, pause and reflect. Did you really know, or are you rewriting the past? This awareness disrupts the illusion and keeps your decision-making more rational. Kahneman's work teaches a powerful truth. Hindsight isn't as clear as it feels. By recognizing how your brain distorts the past, you can make smarter, more objective trading decisions. Let go of the illusion of certainty, and you'll protect yourself from the overconfidence that destroys so many traders. The halo effect, this mental shortcut explained by Daniel Kahneman, reveals how one positive or negative impression can shape your entire judgment. In trading, this means a stock's recent performance or a company's reputation can bias your decisions, even when those factors aren't connected to future outcomes. Here's how it works. When you see a stock that's been rising steadily, your brain automatically assumes the company is strong, profitable, and will keep performing well. On the flip side, if a stock has been falling, you might believe the company is poorly managed or that further losses are inevitable, even without real evidence. This is the halo effect in action. Kahneman explains that our brains prefer simple, consistent stories. When we observe one positive trait, like strong recent performance, we assume everything else about the stock is positive too. But here's the catch. Markets are complex and unpredictable, and one good indicator doesn't guarantee future success. Let's break it down with an example. Imagine a trader who watches a tech stock soar 30% in a month. This recent positive performance creates a halo, making the trader believe the company is innovative, well-run, and will keep rising. As a result, they ignore warning signs like overvaluation, shaky fundamentals, or rising market risks. The halo blinds them to critical flaws, leading to overconfidence and poor decision-making. This effect isn't limited to individual stocks. Traders often give star fund managers or popular strategies too much credit when recent results are good. But here's the truth. Past performance isn't a guarantee of future results. Just because a strategy worked last year doesn't mean it'll work again. So, how does the halo effect hurt traders? 1. Ignoring warning signs. When you believe a stock or strategy is good, you overlook red flags, like bad financials or changing market conditions. 2. Overconfidence in winners. You assume that successful trades will keep succeeding, making you hold on too long or double down without proper analysis. 3. Unfairly dismissing losers. If a stock performs badly, you may assume the company is broken, missing potential recovery opportunities. How to avoid the halo effect in trading? 1. Focus on data, not stories. Kahneman emphasizes the importance of objective analysis. Don't let a stock's recent movement define its future. Study the fundamentals, earnings, debt, and industry conditions before making a decision. 2. Challenge your assumptions. When you find yourself thinking, this stock is unstoppable, pause and ask, what evidence supports this belief? Are there risks I'm overlooking? If the recent performance was average, would I still feel this way? This forces System 2, the analytical part of your brain, to step in and challenge System 1's quick, emotional reaction. 3. Treat each trade as independent. Every trade should be judged on its own merit. Just because a stock did well last month doesn't mean it will continue. Evaluate every opportunity based on current data, not past performance. 4. Use a checklist, Kahneman recommends using checklists to reduce cognitive biases. Before placing a trade, ask yourself, am I being influenced by recent performance? Have I checked risk factors objectively? Is this decision based on facts or feelings? By applying these strategies, you protect yourself from the halo effects trap, ensuring your trading decisions are based on reality, not perception. Regression to the mean is why extreme trading outcomes are often followed by more average results. In simple terms, unusually good or bad performance is likely to return to normal over time. But here's the catch. If you ignore this principle, it can lead to bad decisions and false expectations in trading. Here's how it works. When a stock delivers exceptional returns, traders often believe it will continue performing at that extraordinary level. But statistically, extreme results are outliers, and over time, performance tends to revert to the average. This applies to winning streaks, losing streaks, and market anomalies. Let's break it down with an example. Imagine a stock surges 40% in a month. Many traders assume the stock is on a permanent upward trajectory and rush to buy, expecting the momentum to continue. But what usually happens? The stock often slows down, corrects, or even declines, returning to its long-term average growth rate. That's regression to the mean in action. The same applies to losing trades. If a trader faces multiple losses, they might believe they're in a permanent downward spiral. But over time, performance tends to balance out, especially if the trader sticks to a solid strategy. The bad streak is often temporary. Why traders ignore regression to the mean? 1. Recency bias. Traders give too much importance to recent outcomes, assuming the future will mirror the present. If a stock has been rising, they believe it will keep rising, ignoring the likelihood that average performance will eventually return. 2. Emotional overreaction. Big wins create euphoria. Big losses trigger fear. Both emotions cloud rational judgment, making it easy to forget that extremes are often temporary. 3. Storytelling trap. When something unusual happens, a stock doubling overnight or a sudden crash, our brains create stories to explain it. These stories make the event feel predictable, even though it's often just random variation. How regression to the mean affects trading decisions. 1. Chasing winners. Traders often pile into hot stocks, believing their outperformance will last forever. But high-flying stocks usually cool off, leading to disappointment if you enter at the peak. 2. Punishing losers. When a trader experiences a losing streak, they might abandon a good strategy, assuming it's permanently broken. In reality, most losing periods are part of natural statistical variation. 3. Overreacting to data. If a company reports record profits, traders might assume those profits will continue indefinitely, ignoring that business cycles eventually bring results back to normal. How to use regression to the mean in your favor. 1. Be skeptical of extremes. When you see unusual performance, good or bad, assume it's more likely to return to average than to continue indefinitely. This mindset prevents you from chasing hyped stocks or panicking during temporary downturns. 2. Evaluate the long-term average. Instead of focusing on short-term spikes or dips, analyze the long-term performance of a stock, strategy, or market. Ask yourself, is this performance sustainable or just temporary? How does it compare to its historical average? 3. Avoid emotional trading. When you experience big wins or losses, remind yourself that extremes are part of the process. Don't let euphoria push you to overtrade, and don't let fear make you abandon your strategy too soon. 4. Use mean reversion strategies. Some traders profit from mean reversion by betting that overbought assets will fall and oversold assets will rise. This works well in range-bound markets, where prices naturally swing back to their average levels. A simple mental check. Whenever you catch yourself thinking, "This will go on forever," pause. Kahneman's research shows it probably won't. Markets tend to balance themselves out, and recognizing this can save you from overconfidence and poor decisions. By understanding regression to the mean, you become a more rational, patient, and disciplined trader, one who sees beyond the noise and stays focused on long-term success. The endowment effect, how we place higher value on things we already own compared to identical things we don't. In trading, this bias can lead to emotional attachment, causing poor exit decisions and missed opportunities. Here's the core idea. Once we own something, whether it's a stock, a position, or even a trading strategy, we become emotionally invested. This makes it harder to sell, even when logic tells us to cut losses or take profits. Kahneman's research shows that ownership itself increases perceived value, even when nothing has changed fundamentally. Let's bring this to life with a real-world example. Imagine you buy a stock at $100. It climbs to $150, and instead of locking in profits, you hold on, believing your stock is special and will keep rising. If it drops back to $120, selling feels like a loss, even though you're still up. Why? Because now you own it, and parting with it feels like giving away something valuable. That's the endowment effect in action. It works the other way too. If the stock drops to $80, you might refuse to sell, thinking, I'll wait until it gets back to $100. This emotional attachment blinds you to objective reality, that the market doesn't care what price you paid. Why traders fall into the endowment trap? 1. Emotional ownership. The moment you buy a stock, it becomes yours, and that psychological connection makes it harder to let go, even when it's the right decision. 2. Loss aversion. Kahneman explains that losses hurt about twice as much as equivalent gains feel good. When you already own something, selling feels like a personal loss, even when the rational choice is to move on. 3. Sunk cost fallacy. Once you invest time and money into a position, it's easy to think, I can't sell now, I've come too far. But clinging to losing trades because of past effort only compounds mistakes. How the endowment effect hurts traders. 1. Holding losers too long. You refuse to cut losses, hoping the stock will return to your entry point, even when evidence suggests otherwise. 2. Missing better opportunities. Emotional attachment keeps your money locked in underperforming trades, preventing you from investing in better opportunities. 3. Overvaluing what you own. Just because you own it doesn't mean it's worth more. This bias blinds you to reality, making you rationalize staying in bad trades. 4. Poor risk management. The longer you hold on to something because it's yours, the more likely you are to ignore critical signals to exit, increasing potential losses. How to avoid the endowment effect in trading. 1. Detach emotionally. Treat every position as a tool to make money, not a personal possession. Kahneman's research shows that objectivity is key. Ask yourself, if I didn't own this stock, would I buy it today? What does the data, not my feelings, say? 2. Set clear exit rules. Define your stop loss and profit targets before you enter a trade. This reduces the emotional pull to wait a little longer. When the market hits those levels, act decisively. No second guessing. 3. Reframe your thinking. Instead of viewing a sale as losing something, think of it as freeing up capital for better opportunities. Every dollar stuck in a bad trade is a dollar you can't invest elsewhere. 4. Regularly review your portfolio. Kahneman suggests systematic reviews to fight bias. Ask, is this stock here because it's performing or because I'm attached? Would I still buy it today? If not, why am I holding it? 5. Practice mental neutrality. Detach from entry prices. The market doesn't care what you paid, only what it's worth now. Base decisions on future potential, not past costs. A mental exercise to stay sharp. Whenever you hesitate to sell, ask, if I were starting fresh, would I still choose this trade? If the answer is no, it's probably time to let it go. By recognizing the endowment effect, you gain the power to trade objectively, making decisions based on logic, not attachment. In the fast-moving world of trading, the ability to let go is often what separates the winners from those who hold on too long. Optimism bias. Traders consistently overestimate positive outcomes and underestimate risks. This bias can push traders toward overconfidence, leading them to take unnecessary risks and make decisions that ignore potential downsides. At its core, optimism bias is the belief that good things will happen to me, even when the odds suggest otherwise. In trading, this mindset can cause people to ignore warning signs, downplay potential losses, and overestimate their ability to predict the market. Why optimism bias is dangerous for traders. When traders are too optimistic, they assume their trades will succeed simply because they believe in them. This leads to bigger risks, poor preparation, and a tendency to dismiss negative evidence. Kahneman's research shows that optimism bias isn't just a psychological quirk, it's hardwired into how we think. Here's a simple example. Imagine you've had 3 winning trades in a row. Optimism bias makes you believe you have a special skill or that the market will keep rewarding you. Instead of sticking to your risk management plan, you increase position size, convinced you can't lose. If the market turns, this overconfidence can lead to devastating losses. How optimism bias shows up in trading. 1. Over-leveraging. Traders become so sure they're right that they take bigger positions than they can afford, increasing their risk of major losses. 2. Ignoring stop losses. Optimistic traders believe it'll bounce back, causing them to hold on to losing trades far longer than they should. 3. Chasing unrealistic gains. They overestimate future profits and take risky bets in search of quick rewards, without considering the odds of failure. 4. Underestimating market uncertainty. Optimism bias blinds traders to the randomness of markets. They think patterns are predictable when, in reality, much of the market's movement is driven by chance. 5. Overconfidence after success. A few winning trades can make traders feel invincible, leading to careless decisions and ignoring risk. Why are traders prone to optimism bias? 1. Self-attribution bias. When trades succeed, people credit their skill. When they fail, they blame bad luck, reinforcing the belief that they're better than average. 2. Survivorship bias. Traders see success stories everywhere, people who made millions in the market, but they ignore the thousands who failed and quietly disappeared. This selective view makes the market seem easier than it is. 3. Emotional attachment. Optimistic traders become emotionally invested in their predictions, making it hard to admit they're wrong and cut their losses. 4. Underestimating complexity. Optimism bias makes people think the market is easier to predict than it actually is, leading to oversimplified decision-making. How to overcome optimism bias in trading. 1. Stick to a risk management plan. Before entering a trade, decide on position size, how much to risk, stop-loss levels, where to exit if you're wrong, profit targets, when to lock in gains. Let rules, not emotions, guide your decisions. 2. Challenge your assumptions. When you feel too confident, ask yourself, what could go wrong? What am I ignoring? If this trade loses, how much will it cost me? By questioning your optimism, you create a balanced perspective. 3. Focus on probabilities, not certainties. The market is unpredictable, no matter how sure you feel. Evaluate trades based on risk-reward ratios and probabilities, not gut feelings. 4. Keep a trading journal. Record every trade, including your reasoning and emotions. Over time, this helps you see where optimism bias has led to mistakes and overconfidence. 5. Use pre-mortem analysis. Before entering a trade, imagine it has already failed. Ask, what went wrong? This forces you to consider risks and weaken optimism bias before it clouds your judgment. 6. Diversify your trades. Don't put all your capital into one trade, no matter how certain you feel. Spreading your risk reduces the damage of being wrong. 7. Celebrate caution, not just wins. Reward yourself for following your plan, even when it means walking away from risky trades. Discipline is a sign of a mature trader, not hesitation. A mental check to keep optimism bias in control. Whenever you catch yourself thinking, this can't fail, pause. Kahneman's work reminds us that even the best trades carry risk, and overestimating success is the fastest way to lose. Base rate neglect. Traders often ignore the actual probabilities, or base rates, in favor of recent events or compelling stories. This mental shortcut leads to poor risk assessment and faulty decision-making, because people focus on specific examples rather than the overall likelihood of an event happening. In simple terms, base rate neglect happens when you prioritize a dramatic story over cold, hard statistics. And in the world of trading, this mistake can be costly. Why base rate neglect is dangerous for traders. When traders overlook statistical realities, they misjudge probabilities and make decisions based on emotion rather than logic. Kahneman shows how our minds are wired to favor individual stories. They're vivid, easy to recall, and feel more real than abstract data. But in the unpredictable world of trading, ignoring the base rate can cause you to overestimate the chances of rare events or underestimate real risks. Here's a simple example. Imagine a new tech stock has doubled in 3 months. You hear stories of traders making a fortune, so you jump in, expecting the same explosive growth. But statistically, most rapid gains revert to the mean. Ignoring this base rate makes you blind to the high probability of a correction, and you're left holding losses when the hype fades. How base rate neglect shows up in trading. 1. Chasing hot stocks. When a stock surges, traders often assume it will keep rising, ignoring the base rate that most sudden spikes are followed by a pullback. 2. Overreacting to news. A big earnings beat or market rumor can trigger emotional decisions. Traders forget the base rate that most news impacts fade quickly and overreact to the latest headline. 3. Believing rare events are common. If you see someone double their money overnight, it feels like it could happen to you too. But statistically, huge wins are rare, and chasing them leads to reckless trades. 4. Ignoring long-term averages. A stock that outperforms for a few months doesn't mean it will keep winning. Traders ignore historical averages, leading to unrealistic expectations. 5. Misjudging risk. Stories of people getting rich quickly make traders downplay the odds of losses, even when the base rate shows that most traders lose money over time. Why are traders prone to base rate neglect? 1. Emotional influence. Stories trigger emotions, while statistics feel cold. It's easier to imagine yourself as the next big winner than to accept boring probabilities. 2. Recency bias. Traders give more weight to recent events, like a market rally, while ignoring the broader statistical pattern that markets fluctuate. 3. Overconfidence. When traders believe they have special insight, they trust their gut more than the numbers, leading to risky decisions. 4. Media hype. Financial news focuses on outliers, the people who made millions, not the thousands who lost everything. This skews perception. 5. Pattern-seeking mind. Humans are wired to find patterns, even when none exist. In trading, this causes people to see trends where randomness rules. How to overcome base rate neglect in trading. 1. Check the statistical reality. Before making a trade, ask yourself, what does history say? How often does this outcome happen? Am I focusing on a story or the data? Always ground your decisions in long-term statistical patterns, not short-term hype. 2. Use base rates to guide expectations. If a stock has already risen 200%, the base rate suggests a pullback is likely. Don't assume past performance guarantees future gains. 3. Think in probabilities, not possibilities. Sure, it's possible to make 10x gains, but is it probable? Focus on trades where the odds are in your favor, not just the dream outcome. 4. Apply premortem thinking. Imagine your trade has already failed. Ask, what went wrong? Did I ignore statistical risks? This exercise keeps optimism in check and reality in focus. 5. Diversify to reduce overconfidence. Since no single trade is guaranteed, spread your bets. Diversification protects you from over-relying on any one outcome. 6. Question emotional decisions. If you feel excited about a trade, pause. Kahneman's research shows that when emotion takes over, logic fades. Ask, am I reacting to a story? What does the data say? 7. Track and review trades. Keep a journal of your decisions. Over time, you'll see patterns where base rate neglect led to mistakes and learn to avoid them. A mental filter to avoid base rate neglect. Before you make a trade, ask, what does the average outcome tell me? If your decision relies on hope rather than hard data, you're likely falling into the trap of base rate neglect. The law of small numbers, Daniel Kahneman, explains how people, including traders, often trust patterns from small sample sizes, leading to overconfidence and poor decisions. Kahneman reveals that smaller samples are more likely to show extreme or misleading outcomes, but our minds still treat them as accurate reflections of reality. In trading, this means that a few winning trades or short-term trends can fool you into believing that you found a reliable strategy, even when the broader data tells a different story. How the law of small numbers misleads traders. When traders analyze too little data, they overestimate their ability to predict the market. Kahneman shows that small samples produce random fluctuations, yet people ignore this randomness and draw big conclusions. Imagine you take 5 trades and 4 are winners. It's easy to think your strategy is foolproof, but 5 trades are a tiny sample in the unpredictable world of the market. Luck could explain those wins just as easily as skill. Without enough data, you risk overconfidence and misjudging the true effectiveness of your approach. Real-life examples of the law of small numbers in trading. 1. Early success. A trader who hits a winning streak in their first few trades might believe they've mastered the market. This false confidence leads them to take bigger risks until reality strikes and they experience a major loss. 2. Hot stock fallacy. If a stock rises sharply for a few days, many traders assume it will keep climbing. But in reality, short-term spikes are often random and not a sign of sustained growth. 3. Small sample strategies. Some traders test a strategy over 10 or 20 trades and assume it's foolproof if it works. But Kahneman explains that without a large data set, these results are likely random noise rather than reliable evidence. 4. Overreacting to news. When a company reports one strong quarter, traders might expect future performance to stay just as strong. But one quarter is a small sample, and the long-term trend may not match this short-term spike. 5. Misjudging market patterns. After a few profitable trades, traders often believe they've found a pattern. But Kahneman warns that patterns in small samples are often illusions, leading to false assumptions. Why are traders prone to this mistake? 1. Desire for certainty. The market is unpredictable, but the brain craves patterns. When traders spot a few consistent wins, they feel in control, even when it's just luck. 2. Emotional attachment. When a strategy brings early success, it's easy to become emotionally invested and ignore contradictory evidence. 3. Recency bias. Traders give more weight to recent outcomes, believing that what happened lately will keep happening, even if it's based on too little data. 4. Overconfidence. A few wins create the illusion that a trader has superior skills, causing them to take riskier positions and ignore the broader statistical reality. How to avoid falling for the law of small numbers. 1. Trust large samples, not short-term trends. Always evaluate your strategy over hundreds of trades, not just a handful. A small sample tells you nothing about the long-term reliability of your approach. 2. Question early success. If you've had a string of wins, pause and ask, is this skill or luck? What does a larger data set show? Success in the short run doesn't always mean a winning system in the long run. 3. Analyze probabilities, not emotions. Before making decisions, focus on probability, not how you feel. Just because a trade worked 3 times in a row doesn't mean it's a guaranteed winner. 4. Diversify to reduce risk. Don't put all your faith in a strategy based on a small sample. Diversifying helps protect you from overconfidence and random errors. 5. Use statistical thinking. Adopt a scientific mindset. Test strategies over many trades before drawing conclusions. A large data set smooths out randomness and reveals real patterns. 6. Be skeptical of extreme outcomes. If you experience exceptional wins or losses in a small sample, treat them with caution. Over time, most results regress to the mean. Extreme outcomes are rarely sustainable. 7. Keep a trading journal. Track your trades systematically. Over time, patterns emerge from large data sets, helping you separate luck from skill. Or 8. Slow down decision-making. Don't rush into bigger trades after a winning streak. Kahneman emphasizes that fast decisions often come from System 1 thinking, intuitive but error-prone. Take time to analyze the data rationally. If you found these insights valuable, don't forget to like, share, and subscribe. It really helps us bring more powerful trading psychology concepts your way. And if you have any thoughts or questions, drop them in the comments below. I'd love to hear from you. Thanks for watching, and I'll see you in the next video with more mind-opening lessons to sharpen your trading mindset.